This is InvestTalk, independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Friday, September 9th, 2022 edition. I'm Justin Klein, in for Steve Peasley today, and I look forward to doing this show with you and answering your finance and investment questions. That's our main goal here. The show is dedicated to you, our listeners, and that means the phone number is always open for you to call 24 hours a day, 7 days a week, and that is 888-99-CHART. And I've got a packed podcast for you today, but you know, it's summertime, and I know it's hot here in LA. It was 98 degrees. Even here in Laguna Beach, it was in the low 90s. And Tropical Storm K off the coast of Mexico is making its presence felt here in Southern California. It was raining today. It felt like Hawaii. It was pretty crazy. There's been some flooding, and there's still a total of 15 large incident wildfires burning in the state. And I can smell it as well. So it was a weird day here in Laguna Beach. You smelled fire, but you saw rain and you felt mugginess, that's for sure. But in Montana, where there's more than 30 large incident wildfires burning, it's also very hot. And I think most people are just about ready for the fall season after this latest heat wave. But that is what happened today, and you are less intrigued with that. You're intrigued with what is happening going forward, because that is ultimately how you invest, is how you invest just like you drive through the windshield. And my focus point today is in regard to the strong dollar and the fact that it's wreaking havoc across almost every economy in the world, every country in the world. And this is all because of the Fed's tightening policy, and we're going to dig into the details of how it's affecting the world economy as a whole. I also want to touch on earnings. I know I believe it was it Wednesday? Monday or I guess Monday. We didn't do a show Monday. It was a holiday. So I will have it Wednesday. I talked a little about earnings, and I want to drill down a little bit more on big tech earnings, the FANG names, and what have analyst estimates been for earnings and the change in those earnings over the past 90 days or so. So we're going to check in on that and what is expected for those big cap earnings versus the S&P as a whole. I also want to touch on ESG and what is called the fiduciary duty, which means you have to act in the best interest of your clients. Now, we are a registered investment advisor, which means we are fiduciaries. We have to act in the best interest of our clients. And so we know a lot about what the fiduciary duty is. And I think there's a good argument that the ESG mandate goes against that. So we're going to dig into that because, you know, as ESG marches on and is used as a marketing tool for all parts of the financial world, it begs the question, you know, does it violate the fiduciary duty, which a lot of advisors, RAs mainly, fall under. So we're going to look at that. And then lastly, does it make sense to pay off your mortgage in retirement? So we're going to look at the pros and cons as we enter a higher interest rate environment. All right. So those are things that are on my mind, but ultimately it's about you. It's about your questions. And we have some voice bank questions ready to play. It is Friday. I'll share some highlights from the newest KPP premium newsletter as well. I've got this all planned for this episode of InvestTalk. And of course, I'll take your live calls at 888-99-CHART. Now let's take a look at the market today. Today was a very bullish day. 61 points on the S&P, back pushing north of 4,000 after a fall through from yesterday's modest close above that number. And This is definitely an oversold bounce, but it's been a pretty strong bounce, which is interesting. Going into next week, as we have on Tuesday, the CPI number, which is going to be very important for how the market perceives the future of Fed policy. And, we're going to see. We're going to see how that comes in. Are we rallying into that? Is that a buy the rumor? Is the rumor that that's going to miss? I actually think it is going to miss to the downside, which would be positive for the market. But we shall see. We definitely had very bad sentiment once again. We had bad sentiment in June. We had bad sentiment earlier this week and late last week. I just talking to callers, talking to people that we touch base with regularly, and I always got that sense. Everyone was like, "Oh, I want to hold off. I don't want to invest because I'm worried about the market." I usually get that near the bottoms. Most people get scared when there's the ripe opportunity. And we've had some ripe opportunities in the market over the past 3 or 4 months, but unfortunately, people don't see it that way. They see it emotionally. And that's not what we try to preach here on InvestTalk. We try to preach consistent, logical, down-to-earth thinking and weeding out the emotions. And so if that's one takeaway that you get from this show, is to don't be beholden to the numbers on your screen, right? The price movements. You need to be beholden to good portfolio construction, to good asset picking, whether that's individual stocks, mutual funds, ETFs, real estate, whatever it is, and understanding the fundamentals. And that will see you through the times where most everybody else is getting emotional, but you will be the one picking up the opportunities. And that's what so, earnings for this quarter expect to be up 5% year over year. That's pretty good. Not terrible, not amazing, but, pretty decent. So it's something that you need to take into account when you have this type of volatility. What are the underlying fundamentals of the earnings in the marketplace? Okay. Now let's go to Ken in Maryland. Let's talk about covered call ETFs.
Right. Are you familiar with those? And is that something you would buy for your clients in a portfolio?
Well, we run a covered call strategy ourselves. It's called Equity Income Plus. But we use individual stocks, just like an ETF would. But most of these ETFs are following some index. We're leaning our clients towards energy, towards industrials, towards commodities, towards real businesses and not story stocks, right? And we're buying in that strategy only dividend-paying stocks, which most of these, when you're following an index, there's some dividend payers and some not dividend payers. So we like the idea of a covered call. It does moderate the volatility of an all-equity portfolio. In great years, it will hold it back a little bit. In bad years, it will give you a nice hedge on the downside. In so years, oftentimes you'll beat the overall indices. But ultimately, it's about the underlying asset, because a covered call is you're buying 100 shares or 100 share increments of a stock, and then you're selling call options to bring in more premium to hedge on the downside, bring more income into the portfolio, et cetera. And if you do it right, like we do, then it will boost overall returns. But if you pick bad assets, it doesn't matter. So
right.
So if you're
about these?
Good.
They have particular ETFs that play the indices on a covered call, where you're buying more than just one stock, and they put in the covered call for you on the ETF.
They're doing that. Like, for example, QYLD is one that I get called on a lot. That's the NASDAQ 100 covered call ETF. That's what they're doing in there. Right? They're owning the underlying NASDAQ 100, and then they're selling call options. And I'm not sure there's a lot of different strategies on how you roll those options and manage those options, et cetera. I don't know exactly what they're doing. But underlying asset is the NASDAQ. And so if the NASDAQ goes down, I don't care how good your covered call strategy is, you're still going to lose money, right? So I'd rather run an individual strategy and run a covered call strategy than buy one of these ETFs. But is this better than owning the Qs itself? I would argue yes. Okay, so if you're apples to apples, right? The same index, non-covered call strategy or a covered call strategy, I'm picking the one that has the covered call strategy. But I wouldn't want to own the Qs, so I don't want to own it in either instance. Thanks for the call. Now we're heading into a break, and it's Friday. The weekend is almost here. I'm ready to tackle your finance and investment questions now. You pick the topic. So call InvestTalk at 888-99-CHART.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call InvestTalk, 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Now on Fridays, Steve generally makes time to fit in a quick rundown of key benchmark numbers. So let me hit that list right now. Now the 2-year Treasury yield was at 3.56%, up from 3.42 last week. Now, a year ago, that was only at 2.65. And that was 12 weeks ago. And 25 weeks ago, it was at 1.96. And 37 weeks ago, less than a year, it was at 0.64. So you can see how far the short-term rates have moved basically since the Fed pivoted. Now the 10-year yield, 3.31 at the close, a little bit up from 3.19 last week. And 30 weeks ago, it was at 1.98. 35 weeks ago, it was at 1.76. So it's also made a big move, and that's why you've seen mortgage rates continue to march up towards that 6% level. Gold at $17.15 per ounce, up about $5 from last week, and continues to be kind of in this trading range between $1,700 and $1,900 on the top end. Silver, $18.18 an ounce last week, $18 an ounce, so up only about 1% on the week, and still remains in a long-term trading range. No oil at $86.28 per barrel, down slightly from last week, $87.37, but still 37 weeks ago, it was at $66.62. So you continue to see year over year, it's an increase, but as we get more towards the back half of the year, suddenly that becomes more difficult. And from the inflation perspective, hanging in this $90, $100 range is going to mean downward pressure on the inflation rate. Now, the national average for gasoline was at $3.73, down a tick from $3.80 last week. And about 28 weeks ago, it was at $3.57. So it's still, well above that number, but certainly coming down from the high of, when was that? About 10 weeks back, $4.84. So nice over dollar drop over the past 2.5 months. Here in California, $5.34. And 16 weeks ago, that was at $5.87. So we've had some relief, but not nearly as much as the rest of the country. Now, for comparison, in Ohio, the gas pump today is averaging $3.57. Wish you could get that here. So that was the rundown of the major data points that are feeding into our overall economy. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for their courtesy by getting to their questions quickly. Puma51 says, I've been saving and working at a down payment for a house, and obviously no one can predict the future, but what do you think about the outlook might be for housing market for 2023-24? I'm 26, I live in New Hampshire, and it seems every house is up here is overpriced and much older. I would be very patient. Typically, housing markets run in 3-4 year cycles, and we've just started the down cycle. We're probably 6 months into it. So I would be extremely patient, especially if mortgage rates stay in the 5-6 range. That's going to mean we're going to reset our prices nationally back to 2017-18 levels. So I think we're going to make a round trip from the COVID bump in a lot of markets with rates where we're at now. All right? So I'd be patient. Now we're heading into a break, and I'm ready to take your calls live at 888-99-CHART.
You've got a portfolio to grow and protect, so get your finance and investment questions together and call Steve Peasley and Justin Klein. They're ready with their unbiased answers. InvestTalk, 888-99-CHART.
Now, my focus point today concerns the story behind this headline. A strong U.S. dollar is wreaking havoc across almost every country. And a lot of people don't pay enough attention to this. It's the importance of the dollar in not just our country here in the U.S., but around the world. And it is the reserve currency, and a lot of people have prognosticated that the dollar will lose its status as a reserve currency, but just like our treasuries, it's kind of the cleanest dirty shirt at the moment. And the dollar is soaring to new heights despite, big deficits and the Fed continuing to typically turn to low interest rates in QE, but now they're going the other way, right? They're on an aggressive tightening cycle, really the most aggressive in a generation. And rival currencies are going lower in relation to the dollar. And this is driving up costs for imported goods, constricting financial conditions, and pushing inflation higher. And this is putting pressure on central banks around the world to follow suit, to raise rates. Places like Australia, Canada, New Zealand, they all are increasing their interest rates, and that's also putting downward pressure on their real estate markets, especially Australia and Canada, and I guess New Zealand as well. They all have very expensive real estate markets. In some ways, they never corrected from in 2008, and they continue to rip higher. So definitely some of the worst places to buy real estate right now with higher interest rates. Now, the tightening cycle that the Fed is on isn't new, but this is the first time that the episode has hurt developed countries more than the developing countries. Typically, think of the Asian currency crisis in '98, the Thai baht. That's an emerging market. Well, so far this year, the advanced economies on a trade-weighted basis against the dollar are down 10%. That's a big move for the advanced economies. While emerging markets are only down about 3.7% so far this year. And that has been pushed by countries like Brazil and Russia because they are commodity rich. So a lot of developed countries are not commodity rich. And therefore, they're going out there and having to print money in order to acquire the dollars and to buy those commodities, whereas countries like Russia and Brazil don't have to do that. Most of it's coming internally. Now, the ECB raised their rate by 75 basis points to kind of fight the parity, right? Dollars at parity with the euro for the first time since the late 90s. And the yen is also dropping to the lowest level in decades. And this is putting pressure on them to abandon their very loose monetary policy at 0.25% and kind of follow suit with the rest of the world in the US by raising rates. But so far, they have not done that. Now, across 31 major exchange rates, this is tracked by Bloomberg, Only four developed ones were among the 10 biggest losers this year. And only one, which is the Canadian dollar, another energy-rich, commodity-rich country, that's among the 10 best performers. So you can see this is kind of driven by whether you have to import raw materials or not, and energy. And so this is, in a lot of ways, an energy-driven sell-off in the currency markets. Remember, Japan is an island. They have to import. That's why they're restarting their nuclear facilities, because they just can't afford to continue to import more and more natural gas, which is basically what they've been doing since Fukushima. And, this breaks things. Another factor is that the developed markets, they tend to be in the most debt and have the lowest foreign currency reserves, whereas a lot of those developed countries, they don't have as much debt. They've been exporting goods consistently, whereas a lot of these developed nations have been importing goods consistently. So, the big caveat here will be, if the Fed does pivot, that will certainly help the situation globally, but that's a big if. And we'll know a lot more on Tuesday with that CPI number. But what's interesting is it's already started to move, right? The dollar's pulled back a bit. The euro's rallying against the dollar. Even the yen today was pretty strong against the dollar for the first time in a while. So this is something to watch, because remember, the yen is the third largest traded currency in the world. The euro is the second. So, and these are in massive downturns compared to the dollar. And when you have dollar denominated debts, but your income is in another currency like a euro, like a yen, and those are down dramatically, that suddenly becomes very difficult for you to repay those debts. And that's typically where you get these crises. That's what the Thai baht was. They had too much debt and their currency fell. And that's kind of what you're seeing now. So be on the lookout for this. This is likely where anything that breaks is going to be, the catalyst will be the currency movements, because currencies aren't supposed to move, especially major currencies aren't supposed to move 10% in a year. That's a giant move. Usually it's within 5%. And now, this is creating havoc around the world, like I said. Now we're heading into a break, but I will be sharing highlights from the newest KAPP Premium newsletter in a few minutes. But I want your calls most of all. 888-99-CHART. If you don't know the numbers, you don't know your business. That's true when your business is growing fast, and even more true when there's a lot of uncertainty. Inflation is running rampant, supply chains are clogged, and labor market is tight. What does that mean for margins? But not every business is in the dark, and NetSuite is helping business owners everywhere. Over 31,000 businesses know their numbers because they use NetSuite by Oracle, the #1 cloud financial system. NetSuite gives you visibility and control of your financials, planning, budgeting, and of course, inventory. So you can manage risk, get reliable forecasts, and improve margins. Everything you need, all in one place. In 2022, profit is the new growth. So NetSuite helps you identify rising costs, automate your manual business processes, and see where to save money. Know your numbers, know your business, and get to know how NetSuite can be the source of truth for your entire company. Right now, NetSuite is offering a one-of-a-kind flexible financing program. Head to netsuite.com/investtalk right now. netsuite.com/investtalk. netsuite.com/investtalk. Take a guess. How many job seekers do you think visit LinkedIn every week? The answer is 40 million. As anyone who has ever had to search for excellent job candidates can tell you, finding the right job seeker can be a daunting task. That's why you will appreciate the power of LinkedIn. Create a free job post in minutes on LinkedIn Jobs to reach your network and beyond, to the world's largest professional network of over 810 million people. Then, add your job and the purple #hiring frame to your LinkedIn profile to spread the word that you're hiring so your network can help you find the right people to hire. Simple tools like screening questions make it easy to focus on candidates with just the right skills and experience, so you can quickly prioritize who you'd like to interview and hire. It's why small businesses rate LinkedIn Jobs #1 in delivering quality hires versus leading competitors. LinkedIn Jobs helps you find the candidates you want to talk to faster. Did you know every week nearly 40 million job seekers visit LinkedIn? Post your job for free at linkedin.com/invest. That's linkedin.com/invest to post your job for free. Terms and conditions apply.
You are listening to InvestTalk, and the market has been interesting. So you'll have important finance and investment questions, and Steve and Justin welcome your calls now. InvestTalk, 888-99-CHART.
Hi, I was hoping to get an analysis on One Main Holdings, ticker symbol OMF. I'm really attracted to the dividend. It's a little over 10% at this price. It's a $4.4 billion company. They have it looks like a decent track record. I'm not sure if it's a dividend trap. The company have enough of a cash flow, operating cash, and assets in general, and is their trajectory appearing to be on the right track? Or is it one of those that just keeps issuing shares and cutting the dividend over time? So I'm not sure what the charts are telling you or what the valuation should be. It's been on a downward trend for the last couple of months, and I'm not sure if 35, 36, if that's a reasonable price, or if I should just be patient here and it may go much lower. Let me know what you think. I thank you for your analysis, and I'm a huge fan of the show. I'm learning a lot. Thank you.
All right, great call, and appreciate the kind words. Now, this is One Main Financial. OMF is the symbol, and it's one of the largest non-prime consumer finance companies in the U.S., one of only a few companies in the consumer installment lending industry. And that's the issue here, is that it is highly focused on the consumer, and that's why it's been in decline, and earnings are expected to come down from $9.86 last year to $7.74 this year, and basically remain flat next year as well. Now, that 10% yield looks nice and juicy, but the big question is, can they afford it? Now, if you look at its balance sheet, they have a lot of debt, which is not uncommon for a lending institution, a type of bank. This is basically a very high-risk bank. Now, their cash dividend payout ratio is pretty low, about 39%, which makes me feel good. But their free cash flow, let's take a look at this. It has flattened out, and I think the biggest worry here is the consumer and whether they're going to see a rash of defaults on these, like you have in the auto loan space. You're starting to see those pick up as people have to pay their mortgage, they have to pay their car loan, pay their rent. All these things that were put on, a moratorium. Same with your student loans. You're gonna have to start paying back if you have more than $10,000 in that, next year. So all of these things are going to put more strain on the consumer. You're already seeing the labor market weaken a bit, not dramatically, but a bit. And so that's going to mean lower pay, less jobs, et cetera. Probably not to the extent that we saw in 2008, but certainly at the margins. And that's what the market's kind of pricing in. Now, the question is, has it gone too far, right? Because this is down about 38% from its 52-week high. And if you go based on this year's earnings of roughly $8, that's pretty cheap. You're talking about a 5 times multiple. Now, they are buying back shares, so that's good. So this, like you said on the call, is this a company that is perpetually issuing shares? No, they're not. They're actually using that cash to buy back shares. So I like that. Now, the return on equity, though, that's the 33% now, and that's pretty good, but that's been coming down from 42% late last year. And historically, longer term, pre-pandemic, that was closer to, on average, the low to mid-teens, which is okay, which is solid. But this is just going to be a very volatile name. And I would not expect that dividend to be sustained because of the credit cycle, right? The credit cycle is moving the other way. There's going to be more and more defaults, not less and less. Now, once again, the market has priced some of that in. And has that been enough? That's a very difficult thing to determine, especially me right now. But it does look pretty cheap on a lot of metrics, and the technicals are starting to look a bit better. So I would actually give this a thumbs up. If I'm looking at a chart, let me take a look here. Yeah, it does have major support around $32 per share. Now it's at $37. I'd probably pick it up and use that it's called $30 per share as your out. And, if the credit cycle doesn't turn as bad as the market is expecting, this could be a pretty nice play. That's OMF, One Main Financial. Thanks for the call. Now, the KAPP Premium Newsletter was finished today, and I will be distributing it to subscribers tomorrow morning, and I have a preview. Now, in the market conditions section, we explained that after a steady decline that started in the middle of August, stocks were slightly up this week. With the planned Fed meeting in 2 weeks, every new piece of economic data will be scrutinized. We are in a market where bad news is good news for equities. With every new data point suggesting an economic slowdown, it gives the Fed less of a reason to be aggressive and thereby putting less financial strain on the market and economy. Inflation in Europe has been accelerated by runaway energy prices, which have soared since Russia's invasion of Ukraine in February. Price increases in Europe are also being seen in food, clothing, cars, and household appliances and services. So it seems that Europe is now in lockstep with U.S. policy rate hike. Now, the Beige Book is anecdotal information collected by the Federal Reserve on current economic conditions. It was published with numbers in line with expectations. Consumer spending remains steady, with slight shifts from discretionary goods to food and essential items. Now, due to weak demand for imports, the U.S. reported a sharp narrowing in the July trade deficit. That was a positive sign for short-term economic growth, a potential warning sign for the global economy. Since the U.S. trade deficit remains wide by historical measurements, it reflects the strength of the U.S. economy compared to other major economies. Now, next week, the CPI report will be published along with retail sales. These will be important data points which the Fed can use to establish their tone for its next meeting. Now, in the stock ideas section, we focus on a company that has been primarily engaged in the sale of precious metals, including gold, silver, palladium, and cobalt. It operates approximately 24 mines and 8 development stage projects. These provide exposure to 4 areas of the precious metal industry, giving a diversification among the space. Over 90% of the company's sales come from gold and silver, which are residing in oversold territory. The company currently has a P ratio of 25, and its stock trading near its 52-week low. We've also looked at a provider of building and industrial materials. The company manufactures a range of insulation, roofing, and fiberglass composites. Its projects can improve air quality, fire hazard safety, and energy efficiency. The company has consistently grown both earnings and revenue over the last 2 years, and it looks to continue on that path. With very strong fundamentals, we see this as a solid value position if you are looking for exposure in the industrial space. We name names in the newsletter. Now, there's a good deal of valuable information in every week's version of the KAPP Premium Newsletter. And when you subscribe at InvestTalk.com, you will receive the newsletter each Saturday morning via your inbox. You can subscribe at InvestTalk.com. Now, let's pivot over to earnings and big tech earnings. We're going to talk about Apple, Tesla, Amazon, Microsoft, and Alphabet, as well as NVIDIA and Meta platforms. Analysts are cutting down earnings estimates for these mega cap technology stocks at a faster pace than the S&P itself. Now, the average big tech company has seen consensus analyst earnings estimates for the third quarter fall 21.4% over the last 90 days, and projections for next year's earnings 11.3% decline on average. That compares with the S&P as a whole of a 5.8% decline in third quarter estimates, right? 21.4 to 5.8. It's a big gap. And a 33.1% drop in 2023 expectations during the same period. So you can see that analysts are much more negative on the trends in those large cap tech stocks. And you would say, well, What if they're cheap, though? What if they're cheap? Well, based on those forward-looking earnings, remember forward-looking earnings that have already been downgraded more dramatically than the S&P, the average mega cap stock trades at 38 times earnings, 38, versus the S&P, 16.7. Now, you would say, well, these are just a handful of stocks. The problem is that these handful of stocks account for a quarter of the S&P 500's value. Remember, the S&P is market cap weighted. So the bigger the company is, the bigger percentage of the index it is. And so that's the issue here. It's very, very top heavy, very similar to 2000 when you had a lot of the Qualcomms of the world just being dominant within the major indices. And you have the similar setup right now. Now, only one big tech stock has outperformed the S&P 500 this year. Apple, down 13% this year, whereas the S&P is down about 16%. And that's why I always said, of the FANG names, Apple's always my favorite. Just consistency of their business, the best franchise, best well-run, and it's never really that expensive. It doesn't get to the levels that the Amazons and Googles and Netflix have been on a multiple of any type of cash flow, earnings, etc. And so you can see that this year and why it's been the only one to outperform. So I wanted to highlight that because a lot of people get a lot of calls on the big tech names, and unfortunately, people are overweight those names either through their index that they are invested in, through their 401k, or just their regular account. And it's a time to diversify, and better values are in that mid and small cap space. Let's go to Sunny in San Francisco looking at SQSP.
Hi, Justin. Thanks for taking my call. I'm calling in to get your thoughts on Squarespace, symbol SQSP.
And what do you like about it?
I think the stock has been beaten down quite a bit in the last year or so, and they seem to be operating in a very niche space. So I would like to get your thoughts on what you think is the long-term play for this company.
All right, looking at Squarespace, and this is a company that lost a bunch of money in 2021, but it went IPO mid-2021. Now it's supposed to make 64 cents a share this year, 54 cents a share next year. Revenues growth has decelerated pretty dramatically. It was at 31% a year ago. Now it's only 9%. But the earnings are kind of all over the place. Definitely not a lot of consistency there. We do use their scheduling software. It's called Acuity. So we like that. But if you look at their enterprise value EBITDA, 134%, return on invested capital, negative 8%. And it has been oversold, and the chart is looking good near term, but I just think it's still too expensive. Remember, it's supposed to only make 50 cents next year. That's a 50 multiple, forward-looking multiple. That doesn't excite me, okay? And when you look at the profitability, return on invested capital, negative 8.6%, return on assets, negative 4.5%. You look at the number of shares outstanding, now at 139 million, and that continues to, I guess there's not a lot of history here, but it was 136 million when they went public. So they're still issuing more shares, and it's definitely a growthier name. The good thing is they don't have a lot of debt, but still trading at too high multiple for my blood. Once again, probably going to get a near-term bounce. The technicals are looking pretty decent, but I only see upside into the low 30s. Now we're in the low 20s. So if you want to play it for a trade, sure. But this is not a great long-term buy at these levels. Thanks for the call. Now we can InvestTalk calls from across America and around the world. Let's play a question that came in earlier from the United Arab Emirates and Beyond Meat.
Hi, my name is Ali. I'm calling you from the UAE. I'm looking at BYND, Beyond Meat. I've owned it before, and I did really well with it, but I sold it at a good time. I think that it has really come down significantly, and I think that's probably because of falling sales. But I just want to get your idea as to a good entry point. It has shown a bit of strength recently, and I was wondering what a good entry point would be. If you could let me know, that'd be very useful. Thank you. Bye.
I'll put it simply. 0. Now, there are a handful of stocks in this cycle that were their valuations were built up on a ton of hype, a ton of media, and interesting new ideas. Unfortunately, a good handful of them were businesses that were actually never really businesses, because a business is out to earn a profit at some point. And there's a lot of these names that have never made a profit and likely never will. And Beyond Meat is one of them. So if you're talking about a place to get in for a long, it's zero. For a short, maybe now, right? So absolutely, thank your lucky stars. You got in. It was a nice trade. You made some money. You got out at a good time, right? Because we're pushing on 52-week lows now. And sometimes you do that. You bet in the wrong name, but you get lucky at the right time and you make a good trade. But just because you made money at one time doesn't mean it's going to always, you go back to that well and it's going to feed you. In fact, Beyond Meat is not feeding that many people right now. And because revenue year over year is down 2%, it's going to lose another $1.53 this year. So it's to lose $3.53 next year. It's a $22 stock. They're just burning capital, issuing more shares. This is a zero. Okay. Peloton, another type of name, was operating the best industry ever, best industry backdrop ever, and couldn't make money. Beyond Meat was hyped for a long period of time, and a lot of people got into the meatless craze, and it's still being sold, but they've never had their gross margin is 6.7%. Their operating margin is negative 65%. Think about that. For every dollar in revenue, they're losing 65 cents. It's crazy. So just stay away from this. It's a zero. Thank your lucky stars and move on to companies that make money. This is InvestTalk. I'm Justin Klein. We have one goal here is to help you achieve your own version of financial freedom, and our work continues after this final break. So get your questions in now at 888-99-CHART.
This is InvestTalk. Is your portfolio balanced? Is it optimized? Is it delivering the types of gains you want and need to achieve financial freedom? Well, turn up the volume, because there are many questions that deserve unbiased answers. And Justin Klein is here now, ready to take your calls live. 888-99-CHART.
Let's go to Herbert in San Antonio. Let's talk about earnings calls.
Hello, Justin. Thank you so much for taking my call. I appreciate your podcast. I listen to it diligently. My question today is on company ticker symbol COD as in Delta I. And I was listening to an earnings call the other day, and basically they have $1.3 billion in debt. And the CEO was saying he has all of that debt locked in with unsecured bonds at 5.25%. What exactly does that mean?
Well, he's just saying that their debt doesn't need to be refinanced anytime soon. I don't know what the maturity schedule is. Doesn't sound like he talked exactly about that. But the fact that corporate borrowing rates have gone up a lot with interest rates. And if you're locked in at 5.25%, that's a pretty solid rate compared to what most industrial companies are getting right now. And I think that's what he's talking about. That's good if you are a bit worried about their business and the fact that maybe they might slow. It does look like it's slowing a bit, but it's just talking about their corporate debt structure and the fact that it isn't in imminent need of being refinanced at a higher rate, and therefore a higher interest cost that would feed into their cash flow statements and their earnings statements, etc. So that's likely what he's talking about. Does that make sense?
Yes, it does. Thank you so much for clearing that up. I just wanted to make sure. I have been investing in this company for about 2 years, so just wanted to make sure that that was covered. But thanks again.
Yeah, no problem. Thanks for the call. Now let's touch a bit on ESG. Now there was a big untalked about event last month, and that was that 19 state attorney generals wrote a letter to Larry Fink at BlackRock, warning that BlackRock's ESG investment policies appear to involve rampant violation of the sole interest well-established legal principle. And the sole interest rule requires investment fiduciaries to act to maximize financial returns, not to promote social or political objectives. And 2 states, Louisiana and Indiana, went even further, and they issued a warning that their state pension boards, that the ESG investing is likely a violation of their fiduciary duty. And this means that state pension board members, investment staff, investment advisors may be personally liable if they continue to allocate money to ESG managers like BlackRock, Vanguard, or State Street. Those are kind of the big 3 that have huge market share within the ETF space, have garnered trillions and trillions of dollars of assets, and kind of push the ESG idea. Now, this is putting a spotlight on really what could be an explosive, undisclosed conflict of interest of these big 3 promoting ESG criterias against U.S. companies, but not Chinese companies. And they point out that in 2021, BlackRock exercised its proxy voting rights in Exxon. And that's a big thing here. Remember, these companies who own these ETFs, they have the ability to vote on behalf of shareholders. And they did so in Exxon because they're the second largest shareholder. And it forced Exxon to cut oil production and sell some of its oil fields. And what was interesting is that the oil fields were being acquired by PetroChina, and BlackRock is one of PetroChina's largest investors. In fact, BlackRock has an enormous stake in PetroChina. They've owned between 1 and 2 trillion shares over the last 5 years, representing 5 to 10% of the overall ownership of the company. So why are you're owning both companies and you're just basically forcing one to sell to another? How does that help anything, right? And this is a warning to public pension plan trustees who are under the same fiduciary duty as BlackRock. And this could be the death knell of the ESG industry if you're forcing BlackRock to live up to their fiduciary duty. And in fact, if you look at the report from June of this year, found ESG funds appear to underperform financially relative to their peers, and they charge a higher fee, a drag of 1.45% annually. So if you're investing for ESG, but you're getting worse returns, now you're in violation of your fiduciary duty. And this is something to watch because this is going to go to the courts, and each pension company, pension plan is under its state law. And this could change the dynamic of the pension industry and the ESG world as well. So something to keep an eye on going forward. Now, I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads. And our official InvestTalk download count crossed over 45 million mark on Wednesday, thanks to you. Get your InvestTalk podcasts anytime at iTunes, Spotify, or Google Play, and be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial.